Bloomberg Audio Studios.
Podcasts, radio, news.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
The real data was the June number for PCE. This is what the Fed looks at. Personal income up 0.2%, spending up 0.3%, holding up. You also had a core PCE on a month-on-month coming in just 0.2% and 2.6% year-on-year. So they say this is status quo, John Tucker.
How Goldilocks-y is this?
I mean, or is it just a case of confirmation bias, like you see what you want to see? Yeah. Let's have someone who might have an opinion on that one. Lauren Saidel-Baker is economist and senior consulting speaker at ITR Economics on the data. Is this data like a see what you want to see, or is this a Goldilocks for real?
Result to be, this is not confirmation bias. As we got the GDP numbers yesterday, the economy is still holding up, very resilient. Inflation finally coming down. It was a little more persistent, a little stickier than the Fed wanted to see at the start of the year, but all of the most recent months of data giving them what they need to start cuts in September.
All right, cuts in September. What about July 31st? We heard from Bill Dudley, even Mohammed El-Arian, Bloomberg columnist, saying that they should get it done with and get it done soon.
I think that's the wishful thinking in the room. I do not expect the Fed to be moving in their meeting next week. If we could accuse the Fed of one thing, it would probably not be cutting rates too soon this cycle.
What do you think that what are we going to learn, though? Like, okay, they don't want to cut too soon, but to John Tucker's point, I get next week might be pushing a little bit, but what else are we going to learn from next week until September that will really cement anything? It's just going to be the same trajectory, right?
Well, that's their hope. So the Fed really does want, the word they're using is confidence. And to them, that just means more months of data, additional data points coming in. So they don't want to move too quickly. I mentioned the very strong GDP numbers that came out yesterday. That will very likely be revised in future releases. So they just want to see that the inflation, as I mentioned, has been more persistent, has been stickier, that it isn't starting to creep back up by the end of the summer. Again, I think it's moving in the right direction finally, but because it took so long for us to get here, we had been on a nice, smooth disinflationary track. And then we hit that 3.5% range and things went much more sideways. So the Fed just wants to be sure this isn't a blip. We've had a couple of months of good data. They want to see a couple more.
Well, there's another side to their policy mandate, isn't there? And what's happening on that front? It has been cool.
There is.
Yeah.
Yes, the labor market is actually something they had wanted to see wage inflation cool. If we separate goods inflation out from service inflation, that goods side of things is well under control. It has been for some time now. It's the service side that's been held up by a very, very tight labor market. So they're watching, again, cooling labor has really been expected. Our labor market was just on fire for the past couple of years. I expect long-term we have a floor under labor market activity. We're starting to see the tide shift back in favor of a slightly looser market at the moment. I don't think we're going to go too far that way, though. It's just a demographic issue. We have baby boomers, that huge generation, finally retiring. We don't have a huge glut of workers waiting on the sidelines or aging into the workforce at this point. So the numbers aren't going to materially rebalance this. A little bit of loosening in 2024, but I think that's a temporary trend.
What happens? What happens more quickly when labor starts to cool? Does that really start to cool? Because it also affects personal spending as well.
Sure. Again, I don't think it really starts to cool. Labor has been supporting that personal spending component, which, again, about 2/3 of GDP driven by consumer spending. So that is the floor under economic activity this time around. We do see some echo effects from the pandemic still playing out in the labor market because things got so tight in that 21-22 timeframe. It drew a lot of folks into the labor market. So as we look at things like labor force participation rates for prime age workers, those are at 20+ year highs right now. Again, we've brought more of those workers back to the workforce. The risk now is if we start to see layoffs, or even if we just see more folks entering, again, I don't think there are too many of them left on the sidelines, but that could pull down some of that, say, unemployment rate. I don't think the fundamental drivers are there. And I think the ones that we're seeing are, again, a very temporary issue focused on 2024. 25 and beyond, looks like that tightness will just be grinding tighter still.
Going back to the inflation point for a moment, we have seen freight rates kind of start to move a lot higher. We heard from like Chipotle that their costs are really starting to increase. Like they singled out the price of avocado. And I can appreciate that some of these are idiosyncratic, but is there a danger that certain type of inflation that we felt was done will start coming back?
We will always see pockets of inflation. I mean, avocados specifically, if you look at those trade routes, we get these odd kind of one-off events. So weather events, there's been a drought in the Panama Canal that is keeping ships from getting through. That's really increasing the time and the cost of that journey. So from an economic fundamental point of view, I wouldn't say that's the trend. But yes, weather events, these kind of black swan events, obviously geopolitics, that is the big one right now. I would not want to make any predictions on that front. That's not my expertise. But generally, if we look at major industrial commodity prices, right, raw material cost, most of those are still below the year-ago level. They're trending much more sideways than outright rise or decline. So I hope that's a breath of relief after a few years of very strong volatility. But we'll always be able to cherry pick those examples.
You know what I haven't looked at in a long time?
Tell me.
Just look at the yield curve, the inversion between 2s and 10s. It's less inverted-y.
Technical term.
Yeah, what does that tell you?
So the yield curve, it's a great rule of thumb that yield curve inversions tend to precede a recession. This time around, clearly that has not been the case. We've been inverted for 2 years now, or going on 2 years.
But now it's just 18 basis points separation.
Well, we like to see that come under control. Looks like it might normalize sooner than later, but that was never a guarantee. We've had several historical cases, so a lot of precedent for an inverted yield curve with no following recession. So I think that's a fun rule of thumb. It certainly gives us a great look into, where the market is expecting things to trend, but not an ironclad guarantee. And again, I think the outlier this time around, what really kept us out of that GDP recession was the labor side of things, that tight labor market supporting the consumer.
All right, Lauren, thanks a lot. We really appreciate it. Lauren Saidel-Baker is economist and senior consulting speaker at ITR Economics. Thank you very much.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
There was another story that was reading high, that was a surprise to many, and that is the SEC suing Andrew Left of committing fraud through stock trades, social media posts, and research reports. This is the SEC's biggest move yet in a years-long crackdown against traders who tout these bearish bets. Joining us now is Tom Schoenberg, a Bloomberg Senior Reporter. Tom, can you walk us through what we know about the suit?
Well, first of all, who is Mr. Left?
Oh, sorry. Who's Mr. Left?
Andrew Left is a famed short seller. He has a website, Citron Research, and he's been making sort of bearish bets for years. Kind of a real sort of well-known voice in stock trading.
So what was the problem? Because short sellers, long guys come on, they talk about the stocks they like. Sure. Short sellers come on, they talk about what they don't like about the stock, and they have positions on that benefit if the stock goes down. But we know all of this. So what was the specific problem with Andrew Left?
So what's happening here is we've had both the SEC and the DOJ now, the criminal case alleging that Andrew Left was essentially not trading on the way he was telling the public he was going to be trading. He would essentially profit from going out, either releasing a report or tweets or other social media or interviews saying company stock should be valued at X. And as the market moved to that, he was immediately getting out and sort of making a profit on those sort of short-term stock movements.
So he was saying one thing and doing another, basically.
That's correct. That's according to the government, yes.
This is something that's been kind of plaguing this industry for a while, isn't it?
Well, this is obviously, the meme stock frenzy from about 3 years ago. caused sort of a longer, a deeper look into this, both by, Congress and then, as we're seeing here, the Justice Department, the SEC. And, it looks like they're looking at conduct in both of these cases go as far back as 2018, and with the Justice Department saying as recent as October 2023.
So this conversation happens at home like every 6 months. My husband says, I don't understand short selling. Why do we allow it? And my response is like, because it helps keep markets or CEOs in check because they have someone being more critical on
you're
stuff.
Defending the shorts.
I'm just explaining. But you know what? If we look at it, like, why do we allow short selling?
Right. Well, what you see with, Andrew Left essentially became sort of a well-known short seller, in part because a number of the reports that he released, wound up leading to actual charges against the company or, SEC violations and so on. So he established having a good reputation in the space. And what the government is saying here is that, once he had that reputation, had that audience, he sort of misused that to sort of, essentially fool people into moving to a certain position that he himself wasn't maintaining, even though he gave the illusion that that's where he was.
What are the companies involved? Do we know the names?
Well, we got everything from Tesla, Roku, NVIDIA. There's about I think 24 or more in here.
And how much did he make as a result of this? Do we know what the
SEC? Yeah, SEC is saying that he profited as much as $20 million from this, which also involved, one of the criminal charges against Andrew is for lying to federal agents, claiming that he also didn't receive any compensation from hedge funds. They're saying he received more than $1 million from 2 hedge funds.
Real quick, have we heard from Mr. Left?
At the moment, he's not commenting. If that changes, obviously we will report that.
All right, we appreciate it. Thank you very much, Tom. Tom Schoenberg, Bloomberg Senior Reporter, joining us on that.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Let's get back to the market. Lisa was talking about what's happening in the bond market. You're seeing buying pretty much all across the curve. It's been quite a week, and we've seen a steepener over the last few days that has been quite a week. So we want to get some great insight here with Steve Major. He's the global head of fixed income research at HSBC. I keep saying he lives in Asia. It was Hong Kong, and now he's in Dubai.
Well,
but
the
the
Hong
point
Kong
is
Shanghai Bank of Commerce, right? So
Banking Corporation.
Okay.
But the point is, he's never here. So you have to be on the early show, or he has to stay up late for you in order to get him on TV and radio. But he's here in studio, and this is very exciting. He has a prolific voice when it comes to the fixed income market. Steve, thanks for being here. It's great to see you.
Thank you for having me.
So just broad strokes, what are your calls right now on the U.S. bond market?
Well, it's lower yields. We've tended to have a lower yield, as you know. Mm-hmm. And it's not just for the sake of it. We're not just doing it. We're not doing it to attract attention. It's because we incorporate a more structural and secular approach to the forecasting. Look, if you just do it based on the cyclicals, you'd always have a higher yield. And that might explain why other people think yields should be 5. And so to me, if yields are bearing down on 4 for the 10-year right now, and you ask me where we'll be in a year or so's time, I would say nearer to 3 than 5.
So you're looking at the stuff that's not necessarily short-termy, but the more long-termy stuff.
Exactly, structural and secular. Structural tends to be more things like regulation, perhaps. Secular would be more demographic. So the impact of aging populations, things that...
That's really long-term.
Yeah, well, yes, but then you need to, because you have to have a view on the equilibrium to have a view on the 10-year. Now, this is where many people switch off. They'll say, well, I can't observe this R star or this equilibrium rate, so I'm not going to use it. Well, everyone who buys or sells a 10-year security is implicitly taking a view on that number, because the 10-year yield is not defined by today's policy rate. It's defined by the path of that policy rate and where it ends up in the longer run. So if you think that the longer run equilibrium policy rate is 4, for example, then you think that the yield probably won't go down much more from here. And you would also think that the Fed isn't particularly restrictive.
Okay.
Right? That's an interesting point.
So
Yeah.
Is the Fed restrictive? Because I can't figure out. And then also, when you answer that question for me, what goes into making that determination whether or not they are restrictive?
Yeah, so our assumption is that the Fed's longer run equilibrium is about where the Fed thinks it is, which is 2.5%, and it's sort of 2.7 to be precise, and it's pretty much unchanged from before the pandemic. Now, I would look at this as scientifically as possible. It's difficult to be a scientist in bonds, really, but the point is, what has changed? And it's very easy to say the market indicates something has changed, therefore the world has changed. That's not good enough. All there is a risk premium around the possibility that the world has changed. It's very different. So I think that the policy is restrictive because today's rate is more than double what the longer run equilibrium is.
How do you look at something like fiscal stimulus? And I appreciate that you're going to say that that's cyclical, but when we're looking at something globally from the energy transition, where companies, private equity, and governments are going to be spending boatloads of money in the next 30 years, how does that fit into your model? Yeah,
so there's a debt and a deficit. There's a stock and a flow effect. I think that when you're talking about deficits that are going up and therefore more bonds, you can see how that can feed into the risk premium. But then the debt stock is a drag on longer run growth because it has to be rolled over and financed, and it takes cash flow away from investment and consumption. My point is that it can be a little bit too easy and somewhat lazy to say there's a lot of supply, therefore the yield has to go up, because you really do need to know what's on the other side. Now, when it comes to bonds, the substitution effect, if you like, it depends on the value. What do bonds look like compared to stocks? What do bonds look like compared to money? What do government bonds look like compared to credit, et cetera, et cetera? It strikes me that the valuation argument for bonds is looking pretty good.
All right, so what am I supposed to buy right now?
Well, most real money investors, that's different to a hedge fund or a trader, are sitting in what we call the belly, in the middle maturities, in credit. That way they mitigate the negative carry because the market's implying the cuts. So, good quality, you can buy indices of good quality credit, and you're going to get a yield more than on the S&P 500 forward earnings. And to me, you could have said that at any point in the last year, but ultimately it's a safe investment to be buying good quality US corporates.
What about in the Treasury curve? Where do you think we're going to see the most action?
Alex, you mentioned the steepener. That's been playing out. Do you know that the movement in, let's look at 2s 10s, right? The 2s 10s has moved about as much as it did in the 1 month after the 2016 election, which says that if there is a trade around this, it just played out. It just happened. Now, it's all about the probabilities around the election result, and we've just seen a huge swing in that in the last few weeks. So the idea that it was all one-way traffic and there was only going to be one winner and one outcome with one set of policies, that's no longer clear today. So if the steepener was predicated on that, then I think people will start to think again. So it's, to put a steepener on at this point today, given how much it just moved, I think would be dangerous.
But what if it wasn't about the election? What if it was about pricing in the cuts?
And I think you're spot on, because in fact it's been the recent inflation prints and the cooling real economy that has dominated the scenario analysis and the fiscal views and the election views, and so that's explained the steepening. That's explained why 2s are pushing to the low yield for the last year. But the problem is, if you enter today, you buy a 2-year that is so far through the money market rate that if the Fed isn't cutting, and cutting by more than is priced in on the WIRP screen, you're not going to make any money. And so that's why I think that the steepener may have played out.
Okay, so the obligatory question, we'll finish up with this. September, and what's the path forward beyond September?
Well, baseline is they do 25. The interesting thing is the scenarios around that, whether it could be more. To me, to value a bond today, you need to think about not just the next couple of meetings. It's through next year as well. They're in an easing path, and I think that they will deliver at least what's in the forwards, which makes it difficult to buy the front end, but makes you want to be a bit higher up on the curve.
Steve, it's so good to see you. Stephen Major, Global Head of Fixed Income Research at HSBC. So helpful to understand all those different dynamics. I was taking notes. Did you see me?
Hear from his underground lair.
He doesn't look... Oh, he was just somewhere else. I just mean. All right,
He's
come
like
back next time.
He's the man of mystery.
Yeah, okay, well, we'll just go with it. Steve Major, the man of mystery. Thank you very much for joining us.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
All right, to politics we go. So the latest was that former President Barack Obama and Michelle Obama have officially endorsed Vice President, now presidential candidate. Can I say that now? Kamala Harris? Presumptive nominee, Kamala Harris. Nathan Dean, Bloomberg Intelligence Senior Policy Analyst, joins us now. Nathan, the last sort of, lever falls into place for Kamala Harris. What can we expect over the weekend?
So I'm actually hoping that we don't expect all that much. I mean, after 2 weekends, of having really big news. But, the next thing for us really is to try and figure out who Kamala Harris is going to pick as her vice presidential candidate. The betting markets, which you can find in the terminal at WSL election, are really suggesting it's coming down to Senator Mark Kelly of Arizona and Senator Josh Shapiro out of Pennsylvania. Senator Cooper and Senator Bashar out of North Carolina and Kentucky being the others. But, just remember that Kamala Harris has a lot of time. The Chicago election isn't until August 22nd, and that's when she actually has to pick that vice presidential nominee. So, I'm thinking that they may take some time on this. The news cycle is worth them right now. Maybe they're going to play that up again. So I'm thinking for the next week or so, it could be just more back to what we originally thought, just a campaign for the presidency.
What does history teach us? I mean, Pennsylvania, Shapiro, 19 delegates there?
Yeah, so I don't remember the number off the top of my head, but, for the Democrats, it's this idea of the Rust Belt, Pennsylvania, Michigan, and Wisconsin. The other type of swing states...
I just want to... I should have follow up with my actual question. Picking a vice presidential candidate, does that really move the needle for the person who's on the top of the ticket? Does it matter?
Yeah, I think it would matter at a specific state level. So if you go with Josh Shapiro, obviously I think you're going to get a boost because he's really popular in the state of Pennsylvania. But just to remember that we're also talking about the vice presidential picks here. When it comes to policy and the one debate that's between the vice president, historically it's usually people don't go to the polls to vote for the vice president. They go to the polls and they go to the ballots to vote for the president. So, there's a lot of focus on the VP candidates, and certainly we cover at BI in terms of how they could ultimately influence policy and so forth like that. But, at the end of the day, when people go to November, they're going to be voting for either President Trump or Vice President Kamala Harris.
When do we think we're going to get real policy initiatives from Kamala Harris? I appreciate that in her first sort of campaign speech, she's not going to do that. Like, her goal is to get everyone jazzed up and excited. When do you think we're going to start to hear more specifics?
I actually don't think it's going to come all that too soon. I mean, when we went back to look at some of their policy statements, we had to go all the way back to our time as Attorney General as California. And I think August, they're just going to focus more so on this idea of, the vice presidential pick. And I think you'll see a little bit more on border and a little bit more on immigration. But when it comes to like her economic policy, foreign relations and so forth like that, I think we aren't going to see the specifics until we get to September, which is the debate season. And so after Labor Day, after the August recess, I think Americans will really be paying attention to the race then. And at that point, Kamala Harris is going to have to explain those policy positions. I think the next 2 weeks or so, they're just going to try and figure it out. Just because, remember, her campaign is only, 5 days old at this point? So I think there's still a lot of baby steps that campaign has to do. And then we'll see more and more of the policy statements, I think, towards Labor Day and maybe even to September at that point.
Do you know how long we have to wait before we get really good polling data?
I think it's the first. We've already started to see the first polls that have come out post the Biden decision, but it's early and it's at a national level. I think some more of the state polling data that was more important to us in terms of like Pennsylvania, Arizona, and so forth like that, that's being conducted this week. And so I think, and please don't hold me to this, it'll probably be the tail end of next week when we start to see that.
Do we trust polls now, John Tucker? Is that something that we do?
Dewey defeated Truman, didn't he?
But okay, it was a little bit ago though. So when it comes to the campaign, is the campaign infrastructure for President Biden, is that infrastructure set up for Kamala Harris right now to do what she needs to do and travel a lot and do a lot of rallies and get her name out there?
According to them, yes, but I would say just, it's also, you have the ground staff, but you also have the leadership staff. And I think the leadership staff is going to obviously change, if not in direct positions, but in terms of influence. I mean, look, Vice President Harris had a campaign back in 2020. It didn't go so well for her. She was one of the first people to drop out of the Democratic nomination process. However, the Democratic Party is fairly aligned at this point. And so I think that there are other people out there who are certainly interested, if not serving in the campaign, but at least be able to whisper into that campaign. So I think what's happening right now is that, obviously they're going through this growth. They didn't really have much of a plan up until Sunday or maybe a few days beforehand. So I think they'll have another week or two, but then come August, early August, mid-August, I think they'll be fine in terms of moving forward.
Is there going to be a debate? Is that a sure thing?
Well, I certainly think so. I mean, look, if President Trump, were to back out with one of the dates, the September 10th date, if I recall correctly, is still moving forward, and I think they've invited both candidates for a September 17th debate. And look, if one of the candidates at this point decides to drop out, I think that's a serious mistake on their part. But, it's Washington politics. Anything can happen. But I think at this point, certainly they'll entertain it. And I think ultimately they'll have one, if not two, debates going forward.
Oh, boy. We're definitely watching that.
Well, I'm more interested in, the forum that it's going to take.
Yeah.
So.
All right, Nathan, we thank you. We really do hope you have a weekend for the first time in quite a while. Nathan Dean, Bloomberg Intelligence,
count on it.
Senior Policy Analyst. Don't scare the guy.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Focus on Munis is brought to you by Build America Mutual, insurers of U.S. municipal bonds that finance essential American infrastructure and provides guaranteed income to improve any portfolio. Be part of building America. Invest in BAM.
BAM.
Insured bonds. How'd I do?
Amanda, come on, you can chime in there. Go BAM.
BAM.
Oh, she sounded like me when I first started doing the show.
Yeah, she'll get it.
We're going to get you. You just got to really own it and jump in there. Amanda Albright is a municipal finance reporter, and she joins us from Bloomberg News. Okay,
Picking
Amanda.
up the mantle, I should say, from Joe Mysak. You have some pretty big shoes to fill there, Amanda.
Yes, very big shoes to fill.
But no pressure. We support you.
Yeah.
We miss him and we support you. There were a couple stories that caught my eye this week because I have lack of confidence when it comes to my ability to discuss munis. So I want to make sure that I can handle this segment. Goldman Sachs makes a bet on a muni ETF market, $109 billion muni ETF market. What have they done this week?
Yeah, so Goldman has joined the rush of firms that we've seen that have started offering muni bond ETFs. Goldman Sachs Asset Management already had a muni ETF, but they are kind of getting deeper involved in the space with four new funds. So one of the funds appeals to folks in New York that are worried about their taxes. That's been a common theme lately. There's another fund that kind of mimics like a cash-like fund, except it's tax exempt. So unlike money market funds that are paying, upwards of 5%, you can kind of shield your taxes if you invest in their ultra short muni fund. So we've seen a bunch of companies get further involved in the ETF space just because it seems like that's kind of that and separately managed accounts are becoming a little bit more popular compared to traditional mutual funds.
And these are actively managed funds, right? And you said
Yes.
ultra short, so that sort of sets them apart from others?
Yeah, and interestingly enough, it seems like actively managed is where other companies kind of see more of an opportunity to make an impact. The passive space within muni ETFs is very dominated by Vanguard and BlackRock. They have two extremely large funds that are both passively managed. And so I think it's a little bit harder for other companies to kind of gain market share in that segment. So we're seeing most of the launches within actively managed.
And are they popular?
I was just going to ask that.
Oh.
He stole it.
See, it's a mind meld between the two of us.
Actively managed is definitely it's growing, but I still think it's really hard to compete with two passively managed funds that are, I think when I ran the numbers, it was close to 70 billion between the two of them. So I still think passively managed being, so cheap and so easy for investors to get involved in is still like, we shouldn't write that off. But I think a lot of the money managers are betting that active will eventually gain more adoption.
And I'm guessing that these are for people who live in high tax states, right?
Exactly.
So it's just offered where? Like New York, California, New Jersey?
So there's a California fund and then a New York fund. So when we spoke to the folks at Goldman, they just mentioned that they're still hearing concerns about perennial concerns about high taxes in both of those states. And that's, kind of we're seeing a lot of demand for munis generally this year, and definitely taxes are part of that, especially given folks not knowing what's going to happen next year with tax rates. So taxes are front and center.
Let's move to another great story. It was a big take this week. You and a couple of your colleagues wrote about it, and the title is Harvard's $465 million in tax benefits draw some new scrutiny. Can you tell us about this big take? What was your takeaway, and what did you learn?
Yeah, so we have a story just kind of examining different tax benefits that Harvard has, just given the very intense focus on Harvard for the past, year. We focused a lot on the property side because there's a very rich and kind of long-standing debate over tax-exempt property in college towns across the U.S., not just in Boston and Cambridge. But we found that within Boston and Cambridge, there is kind of a growing push to have Harvard pay more in what's known as payments in lieu of taxes, or pilots. And that's basically an annual payment that Harvard makes every year to account for the fact that its property is tax exempt, which this is a debate that could be had at any college town with any university pretty much, because city leaders are always going to want more from their universities. But I think just the growing wealth at Harvard and, sky high tuition has just kind of reinvigorated this debate. And it's a really interesting topic, and also very relevant to many elite institutions, the debate that's taking place both in city halls, but also in Congress, because the Ivy League has become a major target lately.
Okay. The intersection of politics and munis. Hey, in the muni space, if we can back up what is issuance like, and what are some of the more interesting issues that you see out there?
Yeah, issuance has been pretty surprising this year. I think it's up 38%, a record first half of the year. That was something that Joe loved covering when he was with us.
By the way, he retired. We sound like he's died. He's retired.
Yes, he's retired.
He's on a beach somewhere.
He's he's still rooting us on and reading our coverage. But there's just been so many for just kind of a preview for terminal readers. In a little bit, we should have a story about how a lot of these deals are getting totally gobbled up. There's like kind of, the food fight for muni deals. Some investors are kind of frustrated by this because they can't get enough bonds that they've put in orders for. And we're really seeing this across the board for, even very vanilla bond structures. And then, it's actually surprised me. There's not been a ton of deals that I've been really like, oh, this is so interesting that they're doing this. It's just kind of a typical infrastructure that we're seeing getting funded, and not a ton of high yield issuances, but just kind of across the board, general obligation bonds, AAA, AA, but yet there's so much demand for them. And I think part of that is people are worried that this is a rush before the election, trying to get ahead of any volatility. And people are worried that, after November, these sales are going to go away. So you kind of have to get in the market now while you can.
See, this is exciting. Is anybody on shaky ground?
No, I'm so surprised that everything is just, anytime the U.S. economy is doing well, muni issuers they do well. States do well. I just saw Virginia, I think they had $1 billion more in tax revenue than anticipated for the most recent fiscal year. Like, it's really surprising just how well state and local finances have been holding up. It's pretty remarkable, but that just speaks to the broader economy.
Yeah, I was going to say, like, it is really surprising, particularly as the whole narrative of the COVID funding is running out. They're going to have huge budget shortfalls. And I feel like I have yet to hear that.
Yeah, we definitely haven't. Where I see stress is more higher ed, private colleges. Those aren't kind of typical classic muni credits, or, they're not funded necessarily by tax revenues. But where we're seeing stress is not necessarily states and cities. It's more like a private college that's sold muni bonds. And I was talking with a colleague today about how schools that have been relying on pandemic relief funding, those are the areas that now that the funding is running out, schools are kind of where the stress is being seen rather than like a city. Though, of course, there's probably exceptions out there.
All right, Amanda, thank you so much. We really appreciate it. Amanda Albright, municipal bonds reporter. Does Joe Mysick really email you about your stories?
Of course.
Oh my God, I love that. He's retired, but he's not retired.
He said hi.
He's reading. He's listening. Yes, please tell him that we say hi. I learned a lot. That was really interesting.
And you were so not
I'm so
into
scared.
this segment.
Every Friday munis. I definitely get nervous.
This is the Bloomberg Intelligence Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 10 a.m. to noon Eastern, on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.